Hey guys, my name is Matthew Spazzini here at New Millennium Wealth, and welcome back to my YouTube channel. So today is the second episode of my weekly market analysis that I found two different trading opportunities, or at least practice chart analysis that I wanted to share with you guys. I made you guys this promise in the last video that I wasn't going to let it get to be a very long video. I'm thinking 15-30 minutes max for a normal video. The only reason the last one was so long was I was taking you through all of these different currency pairs, and in reality it just took forever because that's a lot of currency pairs to go through. And usually those, it takes me an hour to go through that many currency pairs anyways in the morning. So I wanted to, and also it was the first episode, so I kind of justified it in that sense. But I wanted to kind of show you guys, so the way I'm going to handle this in the future, and particularly in this video, I did this, is where I'm actually going to go through my list of currency pairs that I'm practicing my analysis on, and then I will show you guys the ones where we actually have an opportunity. So there may be a day when I come in here and I just don't see anything. And if that happens, I might do a video saying, hey, I don't see anything. And maybe I would look for a different kind of trading setup that I intend to backtest, or I've backtested on a few pairs, like the cipher pattern. The cipher pattern is a really cool harmonic pattern. I think that's what they officially call them, and it's a really, really cool pattern. It was discovered by a guy named Darren Oglesby, who was friends, and he worked very closely with one of my trading mentors. And he actually discovered, you can't really say you create these patterns. They've existed for years, about who knows how long they've been existent in the markets. But he discovered the patterns when he was testing Gartley patterns, and he was testing failed Gartley patterns specifically. And he realized that it was a very, very successful, highly successful trading opportunity that he decided to go ahead and more or less start trading. So it's a pretty cool pattern, and I have to refresh my mind on the rules of that pattern. I haven't touched it in a while, but I will probably start doing more market analysis with the cipher pattern as one of those, because I know they're really cool. When you start drawing them, people love those, and they are, and I mean me including. I love those types of advanced patterns and stuff. They're very, very cool when it comes to trading, but and they can be very accurate. There are some people that they just trade those patterns, and supposedly they make money hand over fist. Now, granted, I've never known those people. That's what my mentors have said, and I've never backtested all of those advanced patterns before, but they are very cool, and we'll get into those as well at some point. But for right now, let's go ahead and continue with the market analysis and just show you the trades that I'm looking at that actually did enter, that we were able to get involved with. So today we have the EURCAD and the Euro Pound. The EURCAD, and again, all of this is always going to be on the hourly chart. If it's not, I will specifically tell you that. But for right now, we have we have a situation here where we broke below the lowest low at 146.37, and we closed below that low at 146.22.2. So this is an indication of that the trend is going to continue to be bearish, that is. And basically I measured my fib retracement tool from this significant retracement. It was probably the biggest, most significant retracement outside of this one right here, but this is pretty far away, and I didn't really feel like there was a good chance the market was going to get to there. So I decided to choose this as the retracement that I would measure from. And actually, in this situation, you guys will see in the Euro Pound, this situation is much easier to determine where to choose, where you're going to draw your fib retracement tool from. Over here, this is very obviously a choice, but it's a very big choice, and the odds of it getting all the way up here, it feels like it's not as likely, because the market isn't giving us any kind of indication that it could potentially do that. So the probability of that happening right now, given the information that we have, doesn't seem highly likely at all. Now, granted, that could change. The market could stop me out and start trending up here, and then it might seem like now with the new data, it might seem like it's a bit more probable. But for right now, it doesn't seem like that's probable, and this is very clearly the largest retracement we have in the closest vicinity of the moves that it's been giving us. And sorry, I don't mean to be overly complicated when I'm talking about this, but just trying to get you guys to understand this. Now, in the euro pound, it's not quite so clear cut. There are multiple points that you could have chosen to measure your fib retracement tool to, and as a result of that, it can lead to confusion, and it often does lead to confusion for me as to where the heck am I supposed to draw my fib retracement tool to. And it can be confusing, but it's nothing that practice cannot fix. You just need to get in the markets. You need to practice all the time, and then even then, you need to kind of come up with your own way of how to handle situations like those. And I can't really say that I have, to be completely honest with you. I can't say that I have a surefire strategy for handling those circumstances. I do have some rules around it, but in the end, it doesn't reduce the confusion at all. Sometimes you just get into some confusing moments, and you could just have a rule that says, hey, if I'm confused as to what to do, I'm just going to sit on my hands and wait until I'm no longer confused. But, that's just how it goes sometimes. Okay, so here's the situation. I feel pretty good about this particular trade because ultimately we made new lower lows and we closed below those lows, or the previous lows at least, and then we retraced back into a 6-1 retracement, and we had our initial test, and then we had our retest, and we got rejected the first time, and we got rejected the second time. And if I was to draw some a nice support line here, it would be resistance at this point. What we can see is that this was a support line at one point in time. Like right here, the market bounced off of this area like once, twice, a third time right here, bounced off like 3 times, broke underneath, and then it turned resistance where it bounced off 1, 2, 3, another 3 times, kind of broke above it, but then was rejected almost instantly. And then now we're back up trying to break above it again. So clearly the market has valued this price level right up here multiple times, actually, which is pretty cool to see. One of the main reasons this is also an even handle number, 1.47000. That is an even handle number, and the markets do seem to respect even handle numbers pretty well. It's not a hard and fast rule, but it does seem to. Markets do tend to respect those, or at least they seem to. So we're coming up against resistance right here, and we got rejected for a total 1, 2, 3, 4, 5. For a total of 5 times we've got rejected. So I actually feel like this is a pretty good chance that this is going to hit my entry point and then roll over to give us some hypothetical profits. And then my analysis could stand corrected, which would be very nice because a lot of the analysis that I've done recently is showing not to be as accurate as what I would hope for. Now, granted, I haven't tested this strategy over these currency pairs at all. And to be completely honest with you, we are trading in the summer months. This strategy tends to work when the market is trending. But in the summer months, because so many investors, institutional traders, like banks and hedge funds and all that, a lot of them go on summer break. So volume kind of dries up a bit, and that means you get a lot more volatile, crazy moves. You get a lot more consolidation. You get a lot of moves that just are outside of the norm when the market is just typically trending. So outside of the summer months, the market, all of those institutional investors, traders, those financial institutions, they come back in with their money and the markets start to trend again. And this is one of the reasons why markets can be seen as moving in cycles. Not only is it psychological, but there is a lot of legitimacy to that claim because money flows in and out of markets at different times. And as it flows in, you tend to see much larger, smoother retracements or smoother trends, as opposed to when market kind of pulls itself out, you start seeing consolidation happen, where you start seeing choppy moves and things get a bit erratic and things of that nature. So that does actually, that is legitimate. It does actually occur in the market. So anyways, that being said, that's my analysis for here. I think that because we're retesting for a 5th time right here, this is a good chance that we will get rejected and that we will continue lower. Of course, this is not a hard and fast rule, and an argument could be made that this could be an ascending triangle as well. For those of you who don't know that pattern, basically the market remains flat up at the top, but the market is constantly ascending every time it bounces on this support line until finally it breaks out. And usually this would be an ascending triangle is typically a bullish indicator. Not all the time. You can have false breakouts where it breaks out and then it collapses, or it could just retest these highs again and this price support level and then collapse altogether. So ascending triangles are not always accurate. I mean, there is no pattern that is, but it is something to keep in mind. Some people might say that is an ascending triangle, and it does appear to be so. Some people could just say it's a wedge pattern where the market is being indecisive. So I don't know. All I know is that I see that the market has made a new lower low lower close, is retraced, and because of the new lower low lower close, I'm not seeing any indication this intends to really reverse on me. So hopefully we'll get to see what's going to happen, hopefully in a short time. I personally, personal fun fact about Matthew is I hate it when the market does not give me an answer right away. I like it if it's going to stop me out fast. If it's going to give me profits fast. I don't like it when the market hits my entry and then plays around consolidating for days, if not weeks, maybe comes up here, consolidates up here, and then reverses down here, or it reverses all the way down to the target and then reverses all the way to stop me. I hate that stuff, guys. I absolutely hate it. I don't know one person that likes it. I don't think there's anyone out there that actually likes that, but I detest it. So I would prefer, if I'm going to lose money, let me lose money quickly. If I'm going to make money, let me make the money quickly. You know, that's the general idea. Okay, Euro Pound. Here is a bit more of a confusing situation, in my opinion, because in this situation, there were multiple areas where we could have measured, we could have drawn our fib retracement tool from. So, for example, there are three that I highlight here. If I go back, there are more, but ultimately this one is the largest retracement that I have seen outside of the initial retracement that occurred here right before this bullish trend started. So this is the biggest one right before the bullish trend, not including the one that happened right before the bullish trend started, okay? And ultimately, what I see here is a situation where we have multiple opportunities where we could draw our fib retracement tool to. And the question is, which one do you choose? And if they all get stopped out, at what point do you consider this trend to have reversed and is no longer heading in that direction, is no longer bullish anymore, is now bearish? Because if we actually zoom out to the weekly chart here, what you will find is that we are coming up against the daily, I'm sorry. What you'll find is that we're coming up against quite a bit of resistance, some major resistance levels right here. I mean, we retested here, we broke above, and then we got rejected. Tested here, we broke above for a little bit, and then we got rejected again. We tested it again for the third time, got rejected much faster, even though we did slightly break above. The fourth time, we didn't even break above, and then we got rejected. And now we're coming up here for the fifth time. So what's going to happen? Granted, I do think that the overall Euro Pound market is bullish long term, because if you look at it here, we had our initial high, our initial low, new higher, new higher low. So that is generally what you want to see when you see a bullish trend. But the question is this going to continue higher and then break above new higher highs? Maybe. It might. It could just consolidate sideways. You never really know how this stuff is going to go. But overall, what we are dealing with right now is a lot of resistance. And the truth is, this area has been respected by the markets over and over and over again. And in reality, if we actually come up here, this 91,000, right? 91,000, I guess. Which I know that's not 91, it's 0.91000. But if you actually look at that, is an even handle number. And the market has respected, the markets tend to respect these even handle numbers a lot. They tend to respect even handle numbers a fair amount. Now, it's kind of subjective. Some people don't give it any credence. Some people do give it credence and value. But the theory is that the markets basically respect these even handle numbers. And that when the market comes up to these even handle numbers, resistance levels and support levels tend to form around those numbers. Now, is that true? Yeah, I mean, I don't know. I mean, here's 87,000, and you can see we retested 1, 2, 3, broke below, but kind of got rejected. So 4, 5, 6. I mean, you know, it did bounce off of it a number of times. Not to mention it rejected here, here, and here. So yeah, I mean, the markets do seem to value these. I mean, it's not something I'd want to base an entire trading plan around, but I wouldn't mind at least taking it into consideration when you're making your trades, okay? So ultimately, where is the market going to go? I think I chose this retracement level simply because I felt like it was a bit more significant than this one. But that was very subjective. When I initially found this, I initially made my measurement here. And it was around right here. But the market just didn't look like, it wasn't giving me any indication that it intended to rally from here. It just, the candlesticks were quite small. They just didn't really look, it didn't look like there was any real indication there. So I decided, and it looked like it was just going to continue downwards and continue going lower. Now, in my most humble opinion, I also didn't like how, even though this particular move broke new higher highs, when it retraced, it retested this consolidation point right here. And in my opinion, that leads me to believe that this is a bit less significant than this retracement down here. So I decided to blow that one away and value this retracement better, because this retracement, literally we extended past this one, we broke above this retracement right here, and we broke above this extension level, this recent highest high, and then we retraced, and then we went ahead and then we extended again. So far, at least with regards to the fact that this is just a smaller retracement, and it's too small to the point that the market didn't really value it as highly, and that was really the reason why I didn't choose it. I mean, yes, the fact that it retested here was a bit of some concern, but to be honest, this just retested this low right here. So in reality, it was really more the size. The size of this retracement was just not that big, in my opinion, from here to here. And in reality, it just wasn't that big of a retracement. Sorry, from here to here is what I was referring to. This blue line is not nearly as big as this one is. You can see there is a size difference. So I didn't really personally feel like the market was going to value it. So I decided to measure my fib retracement tool here. I could totally get stopped out, and it could have been this big move, which the market really respected. And honestly, that would be par for the course. I mean, that happens to me all the time. When you have situations like this, it's not like the EURCAD where it's very obvious, it looks very clear and clean cut, and it's easier to determine where to draw your fib retracement tool to and where you could put your stop loss. Well, when it comes to a situation like this where you have multiple choices, generally speaking, you want to go with the biggest retracement that you can find, or at least relatively the biggest one. And unfortunately, I chose, well, I don't know whether it's unfortunately, but I chose this one, the second biggest one that's closest to the actual market, the actual market retracement that we're having right now. If this gets stopped out, then I'll look to see if the market has reversed, and then we'll switch our trades up from longs and we'll start to go short. We'll start to see if there are any shorting opportunities. And I might have to absorb a second loss because it could be a complex pullback, which is a little different. For those of you guys who don't know what a complex pullback is, I'll give you a very quick example of it. I hate them with a passion, but they are something that constantly that constantly happens all the time, and it kind of sucks. So basically, you have a very obvious bullish trend here, and it appears as though we're just going to retrace again. This is the third movement, the third wave, I guess, if you're a fan of Elliott wave theory or whatnot. This is the third extension that we have had. We can actually make this extension a little longer. So the third extension that we've had, and for me, I would basically want to measure from here to here, and I would say, okay, if we get to a 618 retracement, I'm going to go ahead and get long. So that's what I do. I go ahead and I get long right here. But in a complex pullback, what we tend to have is a situation like this. It comes up, all is good in the world, life looks great, and then it does that. Boom. This is a complex pullback. Not only did it stop us out because let's assume that my stop loss was somewhere. Let's assume the stop loss was there. I don't know if the stop loss would have been there or not. I'm not going to bother actually doing the actual measurements correctly. This is just an example. And then our target was clearly right here. Okay? So, and this situation occurs all the time where you have a retracement of the overarching trend. You have what appears to be price action trying to get back up here, gets rejected. It actually doesn't even get rejected, it just doesn't get that far up. And then it retraces again. And this sometimes leads me to think that, oh, this is going to continue to reverse. This is going to reverse now, and now I can go ahead and measure this point. I don't want that anymore. I can go ahead and measure this point right here, or maybe even this point right here, and I'll look for another fib retrace, another 618 retracement up to here. We'll go ahead and blow these away. We don't need these anymore. Put my stop loss, above the highs here. Put my target here, and we'll go from there, right? And that's what and so I reversed my analysis. Now I'm thinking this is bearish. And when the market comes up, touches my entry, but then retraces a little bit. Sorry, that's not what was supposed to happen. Retracement traces just a little bit, comes up here again, does this, and then, boom, stops me out. Pretty much sucks when this happens, because ultimately you absorb two losses. At least the current trading strategy that I have with the current rule set that I have, or at least the way I've been trading. I don't know if I actually put in the trading plan that, and I think I mentioned this in the last video, I don't think I actually put in the trading plan that I have to more or less take the second, I have to treat it as if it's reversing. But that's what I tend to do, because in consolidation times, it tends to reverse a lot. And if it does reverse, I want to catch the reversement. But that's not always what happens. So this is a complex pullback. There are many ways in which you can handle it. You could take one trade here. All right. You can try to take one trade here at this point. Turn this to yellow. You could try to take that trade here, or, and if that stops out, and if that stops you out, then you could try to take a trade again here. Now, with a complex pullback, that is probably the best way to handle it, because you'll get stopped out on this particular trade, destroying that one, but on this one, you'll actually end up making decent profit. Now, what happens when it's here? Where do you take the trend? So, honestly, in this particular situation, this is a pretty crappy situation overall. What typically happens, or what has happened here, is that we retrace to a 618 retracement right here. I mean, if you did this already, then ultimately you would have had to place, it really was a matter of how far your stop loss was. Because in reality, there is no predicting whether it's going to come all the way down there or whether it's going to come right here. Okay, sometimes complex pullbacks don't actually break below the structure points, and sometimes they do. If they do, that's why you have to determine how far you want to put your stop loss. If you want a more dynamic way of placing stop losses, one of the things you can do is you can use the average true range indicator. I don't like to use indicators very much when it comes to trading, but there's only two indicators that I might actually consider when it comes to trading in general. There is the relative strength index, which is what I'm using currently right here. I don't actually factor it into my trading plan at all, but it does act as another filter. If you want to, you could say, okay, is the market oversold? Well, the market did go oversold here, so yes, the market is oversold, but currently the market is not. The market was even more oversold right here. Usually meaning, if the market is oversold, normally what tends to happen is that you have a reversal in the RSI, and then you have a spike. You do actually have that. You have that in this case right here. As you can see, the market was retracing. It went oversold with the indicator, and then it rallied. But look at this situation. It went oversold right here, and then it could just continue to go down. Or this situation, it went oversold right here. It continued to go down, it continued to roll over again, and then it kind of rallied a little bit, consolidated sideways, and then rallied. So the RSI indicator is not a foolproof indicator, okay? Not by any means. Now, here's another great example where the relative strength index went oversold and then rallied right off that. So I'm not saying it doesn't happen. It does happen. I wouldn't base an entire trading strategy on it. Here's another situation where it went oversold and then it rallied after that. So the relative strength index can be helpful, and you can incorporate it into your trading strategy if you like, saying that in order for me to get long, I have to have the RSI be oversold, and then that means that there's a chance that it's going to reverse and rally, thereby and it will try to become overbought at the top here, and hopefully I'll get a spike out of that over that oversold action right down here, and then I'll end up making money. I'm sorry, I'm being kind of confusing when I'm saying that, but you can use the RSI, the relative strength index, to determine and incorporate it into your trading strategy if you want to. I personally don't. I have it up here, but I don't really use it a lot. I just like to use pure price action. That's all I like to do. Now, if you're interested in the settings that I use a 7 period, 7 length, so it's going to count the past 7 candlesticks, I think, and that's actually what I do. I use, and the upper band. Now, normally the upper band that determines overbought is usually set to 60, I think. I set it to 70, and usually the lower band is set to 30, or I think it's set to 40, and I set it to 30. No, actually, my mentors did teach me how to actually use these, the parameters that you want to enter into your RSI. I think the low is supposed to be 20, and I think the high is actually supposed to be 80. I could be wrong with that, but I think that actually is true, because it makes it significantly harder for you to get an oversold category. So now the oversold is here, and overbought is all the way up here. So you see, the overbought was here, and then we rallied. We lost momentum, or we rolled over. We lost momentum, we rolled over. The oversold thing was right here, and we haven't really rallied off of that yet. But so, anyways, I think those are the parameters that I was taught to do, an 80-20, and then the input was 7. I mean, you could use 14, set 14 if you wanted to. That would make it much, you're now including a lot more data in there. So your overbought condition was here, and we definitely sold off. But it's actually been harder for them to get oversold. We almost got oversold right here, and then we rallied, but we never really got oversold. So you could use more, you could use less. Like a 3, look how erratic it is now. Good gracious. So I choose to use 7. I'm pretty sure that's what I was told to use. I'd have to go look at it again and make sure that I'm right. But with the average true range, You can use an ATR if you want, and I was taught that you could basically use 7 or 12 period ATR, where it takes the past 7 or 12, whichever number it is, but it takes the past candlesticks on whatever number you enter. So that if I was to say 7, it's the past 7 candlesticks, and then basically it uses that to determine the average true range of the market. And then what you would do is you would multiply whatever number it gives you by 2, and then that's where you would put your stop loss. It's a very dynamic way of placing stop losses. I'm not using that here. I just use 10 pips. I say 10 pips below the lows or above the highs if it's a shorting opportunity, and that's what I do. It's an arbitrary number, I admit, and it's not perfect, but it does seem to help. It does seem to help me. And honestly, it keeps my risk low. Average true ranges will tend to give you, depending on how volatile the stock is, it will tend to give you fairly larger stop losses than simply a 10 pip stop loss. So just take that in consideration when you're looking into using it. It's certainly not a bad thing to use. In fact, when I was backtesting the cipher pattern, I never actually finished the backtesting, which I really need to go back and finish it. I got caught up in shiny object syndrome. The performance of the cipher pattern was not exactly what I wanted to see, so I ended up nixing it for another trading strategy. I will eventually go back and continue with the backtesting of it, but I used an average true range on that strategy, and for the most part, it worked out really well, except for the currency pairs where it didn't, and then I wouldn't have traded on those currency pairs in the first place. But anyways, back to the situation. It's difficult to know where to draw your fib retracement tool to. I decided this one because I felt it was bigger. It was a bigger retracement than this retracement was. Honestly, they're of similar size. This is not that much larger than this one. This one is significantly larger, but here's the benefit of using this one is that my entry would have been a little lower, but even if the market does retrace down and respect the 618 retracement down here, I still would not have been stopped out quite just yet. Now, my stop loss would have been much further. And I'll be completely honest, if I do get stopped out here, I may consider taking this particular trade. Actually, probably not. I probably wouldn't take this trade. I would just sit on my hands and wait and see what happens, because if it stops me out all the way down here, in my mind, this is too close to this area. This is more than likely going to stop this out as well, and violate these lows as well, and it could very well just reverse and have a little bit of a bearish reversal. So that's what could happen, and particularly when we're coming up against such extreme resistance levels like we saw earlier, it's a high probability that it could just reverse for a while and then continue higher. We never know. So anyways, but those are the 2 trades that I saw for today. I hope you guys enjoyed it. I hope I gave that in-depth analysis. The main idea of these videos is to give you a much more informational, in-depth analysis than what you would typically get if you just simply read my descriptions on TradingView. And the main idea is to give you guys that analysis that you want, where I actually talk about it. I actually go through with you the processes. If I'm struggling with determining where to place a stop loss or where to place an entry or where to measure a Fibonacci tool from, I'm going to tell you. I'm not a consistently profitable trader, as I've mentioned many times. This is my journey to becoming a consistently profitable trader, and this is just for practice purposes. I'm just practicing by practicing my analysis. And ultimately, it's a very good idea, because when I actually get to backtesting this particular strategy on all these currency pairs, it will give me such a clearer mind of the type of rules that I actually want for it, because of all the things I actually struggled with live data in the real market. So doing this kind of forward testing with live data is very, very helpful to determine what you want your trading rules to be, and just kind of going from there. So anyways, guys, well, I hope you guys enjoyed that, and yeah, if you liked it, please like the video and subscribe to the channel, and don't forget to check out the website at newmillenniumwealth.com. If you haven't checked out the Facebook page at New Millennium Wealth or the Pinterest page at Matthew Spazzini. Go ahead and check those out as well, guys. Again, I'm trying to grow this community of individuals who want to all come together and basically learn to become financially free and consistently profitable together. You know, the goal is not to come here saying that I've got everything figured out, because that's what everybody does. The goal is to say, I don't have everything figured out. I have a lot of knowledge from a lot of study and research over the past 4 to 5 years, but I'm not financially free. I'm not a consistently profitable trader. So I have all the head knowledge. I'm now taking the action. And my goal is, by you guys seeing me take the action, but not having everything figured out and not, knowing exactly how things are going to work out, hopefully that will encourage you and even motivate you guys to take action in your own lives. And that's the general idea here. That's the goal. I want you guys to see the real journey that is really ahead of you if this is something you want to do. And I want you guys to see the truth. So many people come to the market with their trading courses on how to become financially free, how to become consistently profitable, and in reality, they've already done all the work ahead of time, and now they're consistently profitable, or so they say. You do have situations where they're lying, but let's assume that they're telling you the truth. You lose out so much information, and you lose out so many learning opportunities when you don't get to see the journey that they went to become there. You don't get to see how it took them 2 years. You don't get to see how much money it actually required. You don't get to see how much stress and how much aggravation was really involved. And I know those can be kind of depressing things, but guys, I feel like we really need to know the truth. We need to know the truth about this stuff, and we need to know, is this actually going to be something that I want to do? And what is the reality? What should I really expect here? And that's something that I think that everybody needs to know. You need to know the truth. And that is my promise to you, that I'm going to be as transparent as I possibly can, as truthful as I possibly can. But, I'm going to be truthful to you guys. I'm going to be transparent. My promise to you is I'm not going to lie to you. I'm not going to tell you something that isn't true. I'm not going to say, oh yeah, well this strategy is profitable when it's not. Or, yeah, it's profitable, but only on 2 currency pairs. Who wants to trade it on that? Then you got to watch those 2 currency pairs all the time. I would much rather have something that's profitable on a lot more. And I wanted to show you guys the overall journey that this entails. And hopefully help you guys become consistently profitable with me. And financially free as well, not needing to rely on a job. So anyway, guys, hope you guys enjoyed all that. If you liked it, like the video, subscribe to the channel, and don't forget to check out all that other stuff that I said. Alright guys, well, I'll see you guys in the next one. Remember, know the risk, plan accordingly. Have a great day.